Hello, everyone. Thank you for joining our Moving Markets podcast and our monthly recap. As always, I'm joined by David Sokolovsky. We're going to recap the month of July, which was an important month. A lot happened. We finally got the headline of a recession, maybe, for now, and a reasonable recovery in stock prices, which we've talked about for most of the year, looking into the slowdown that many times by the time we see recession or 2 quarters of negative growth, asset prices already start to recover, and that seems to be the case so far, David. So let's look a little bit into the numbers for the month of July.
Yeah, so July being very different than most months so far this year, we had the S&P, Dow, and Nasdaq all up for the month. S&P was up about 9%, the Dow was about 6.5%, and the Nasdaq was up about 12.5%. And it's no surprise that really a lot of the companies that were very beat up in the first half of this year are the ones where you saw a large improvement. That being said, if you take a deeper look into what was driving some of the market returns, you notice that consumer discretionary, which is an area that typically doesn't do well in recessions, was up 18% for the month. And you had tech, which is we've all talked about over the last couple of months, make a recovery of about 13%. So overall, really a strong month and positive across the board.
And when you look about this year so far, as we recap, we expected a tougher year. We thought maybe March would be the bottom, and it turned out to be, with inflation taking another leg higher and a lot of the events overseas, it turned into be a very rough second quarter. But now when you look at what's unfolding, we were very cautious. July, we did our most amount of buying and investing for the year. Right? We put a lot of cash to work, both in the stock market and bond market. And as we look to the second half of the year, August and beyond, we still remain pretty cautious. But looking at some of the headlines there, David, what are we looking for, ahead?
Yeah, so looking ahead, it's really three things that are going to be very important heading into the rest of the year. One is inflation. Two is the Federal Reserve and their response to any potential inflation. And three is the strength of the consumer and the health of the consumer. So if we unpack those, inflation being the primary driver, even if we look out over the next month, the expectations for June are about 0.2%. A lot of that's being driven by oil prices coming down and other prices not growing as rapidly. It's still very high compared to last year, but what we're looking at and what the Federal Reserve is looking at is the pace. So from this point forward, what does inflation look like? If it's going to continue to run at very elevated levels, the Federal Reserve is going to continue to increase rates. But as we look to the Fed, they have completed another 75 basis point increase in July and have signaled a little bit of a pivot. So maybe slowing down, giving some time for the previous rate increases and the most recent one to have an impact. And lastly, the consumer. So as we look at the consumer, we see that the consumer remains pretty strong. Certainly some companies have come out in the consumer discretionary space and mentioned that inventories are a challenge. Consumers may not be spending as much, but when you look at credit card companies, for example, that have a broader view into the overall health of the consumer, they're still seeing very strong spending. They're just seeing it done differently. So for example, they might see the spending that you're doing on services, on travel, on other things, and maybe that's money that you're not spending in a store. So that's something that we have to keep an eye on and make sure the consumer is healthy and has the ability to continue to drive the economy. Again, our economy is 2/3 driven by the consumer, so it's a huge part.
Let's go back to that inflation number or expectation, because that's one of the keys looking ahead, as you said, David, is inflation expectations and numbers are going to drive the Fed from here. It's going to help us make better decisions with portfolio allocations as well. But when you look at the math on that, the month over month, only 0.2, right? The year over year, as we saw in June, was 9.1%. If you do the math at 0.2, if we continue at that pace, nobody's expecting that. But that would put us back into the 2.5% range of inflation. That's a big deal. We need to see many months of those types if that comes to fruition next week. But these are the things that are going to be clear drivers of Federal Reserve policy in the markets ahead. And when you look at consumer behaviors, we saw this with a lot of the earnings reports so far. is if you happen to have the wrong inventory, it was a very big problem, right? I mean, the last 2 years, there were no sales. For the most part, all the inventory you had, you were able to sell immediately, and in many cases at premiums, given the inflation we've seen. But now the second half of the year to see a lot of sales at stores and other things as big box stores look to move inventory that hasn't sold as much as we spend differently. And again, look into after Labor Day, when this surge of travel and services kind of ends. It'll be interesting to see if we get back to kind of the old way of spending, where we all spend a little bit everywhere. You travel, David, maybe I fix up my house, other people go shopping for clothes, and it's kind of spread evenly. The last 2 years, we've all kind of collectively done the same thing at the same time, and it's caused a lot of the supply chain and other things. So it'll be interesting to see if that happens, past Labor Day and other things.
Yeah, and as you mentioned about spending differently, so one of the areas is housing, and we've really seen over the last couple of years, housing remained strong. Prices have continued to increase, but now over the last month or so, we've seen some of that pressure easing. Part of that was driven by higher rates. Part of that was just driven by potentially lack of inventory. But if you take a look around now, in terms of what was driving some of the inflation, because housing prices increased 20% year over year for a few months straight now. If some of those prices have come down, and we anticipate that they did, in June we'll see more information on that, as data becomes available. But that's again another area where inflation pressures may ease.
And as we look ahead, the risk reward of allocating money near term, the bond market still offers a very compelling risk reward. Again, I look back to the early 80s when you could get a 3-month CD or a 1-month CD at 15 or 18%. And you had a choice, either buy that, inflation was very high at the time, or look for a very long treasury bond at the time. You could probably get close to 9.5%. It's compelling right now that to stay short term with your fixed income because of the high inflation. But the reality is, when you look back to the 80s, you were better off to avoid that 15% short term and buy the long term. So it is a good time to actually look at longer duration bonds, in our opinion, to lock in some of the higher yields that we haven't seen in a while. And then when you look at the stock market overall, there's a lot of value in the markets at this point, but it's going to be heavily dependent on where we're spending to see what becomes even better value or what should be bought at this point. So a lot of what we did in the month of July was kind of buy everything, because it isn't very clear what is going to be the better opportunity, but we'll have more of that data as the earnings season kind of evolves here and plays out over the next few weeks. And with that, we'll see kind of where we allocate. So for that, I want to thank you for tuning in this month, and we'll touch base next month to see what we should have done this month and recap what happened.
Thanks, everyone.